The $6,000 senior tax break Roth IRA trap most retirees miss. A brand new tax law has been passed, and it's going to affect millions of seniors starting in 2025. You likely heard the government talking about a new $6,000 tax deduction for seniors. For a married couple, that could be a $12,000 gift. But what if I told you that for the right person, this is a strategic opportunity, but for the unprepared, it's a minefield? What if this gift is actually a cleverly disguised trap? Taking this deduction could collide with one of the most popular retirement strategies, the Roth IRA conversion, and accidentally trigger a massive tax bomb. This isn't just a small tweak, it's a financial disaster waiting to happen. In this video, we're going to break down exactly how this new law works, expose the hidden trap buried in the fine print, and give you a clear strategy to navigate what I'm calling the golden window of opportunity. Section 1. The new law. Okay, let's start with the basics. What is this new tax break? Starting in the 2025 tax year, there is a new temporary tax deduction specifically for people age 65 and older. Let's call it the senior bonus deduction. The headline number is a deduction of up to $6,000 for an individual or up to $12,000 for a married couple if both spouses are 65 or older. The key words there are up to, and we'll see why that matters in a minute. What makes this so powerful is that it stacks on top of your other deductions. Let's look at a best-case scenario for a married couple, both age 68, filing taxes for 2025. First, you have your base standard deduction. For 2025, that's projected to be $31,500 for a married couple. Next, you add the existing age bonus you already get for being over 65. That's $1,600 per person, so for our couple, another $3,200. And now, you add the new senior bonus deduction. In a perfect world, our couple gets the full $12,000. Let's add it all up. $31,500 plus $3,200 plus the new $12,000. That's a grand total of $46,700 in deductions. That's staggering. Think about that. Over $46,000 of your income that the IRS cannot touch. Before this new rule, that number was just $34,700. This is a massive potential tax savings. It looks like a simple gift, but this is where the simple gift turns into a puzzle. Section 2. The hidden catch. Here is the part no one is talking about. This generous $12,000 deduction isn't guaranteed. The complexity is in the fine print. The deduction comes with a phase-out based on your income. This is the hidden rule that turns the opportunity into a trap. The phase-out is based on your Modified Adjusted Gross Income, or MAGI. It's a specific income calculation the IRS uses for all sorts of things. The tripwire is set at a MAGI of $150,000 for a married couple and $75,000 for a single filer. The moment your income crosses that line, the deduction starts to disappear. And it doesn't disappear slowly. It drains away at a rate of 6% for every dollar you are over that threshold. For every extra $1,000 you earn over that line, you lose $60 of the deduction. For every $10,000 you're over, you lose $600. The deduction is completely gone once your MAGI hits $250,000 for a married couple or $175,000 for a single filer. At that point, it's as if this wonderful new tax break never even existed. You went from a $12,000 deduction to zero. So, the critical question is, what could you do that might unknowingly push your income over that line? And now let's connect the dots to one of the most powerful tools in your retirement toolbox. Section 3. The Retiree's Super Tool, the Roth Conversion. Before we spring the trap, let's talk about the Roth IRA conversion. As you know, if you're a retirement nerd like me, your traditional 401k or IRA is a tax-infested account. Every dollar is a promise to pay the IRS later. How much of that money is actually yours, and how much belongs to the government as tax rates rise? A Roth IRA flips the script. You pay tax on the money now, and in exchange, it grows and is withdrawn 100% tax-free in retirement. It's a brilliant strategy. A Roth conversion is how you move money from that pre-tax traditional IRA to the tax-free Roth IRA. Anyone can do it. It's a key tool for what we call Magi control. But there's one unavoidable consequence. The amount you convert is added directly to your taxable income for that year. If you convert $50,000, your income goes up by $50,000. And right there, that simple fact is the trigger that springs this entire trap. Section 4. The trap is sprung, a real-world example. Let's bring in our couple, John and Mary, both 68. They've saved well and want to be smart. Scenario 1. No conversion. In 2025, their Magi from Social Security, a pension, and investments is $145,000. They are just under the $150,000 cliff. They get the full benefit. Their total deduction is that beautiful $46,700 we calculated, including the full $12,000 senior bonus deduction. Scenario 2. The small Roth conversion trap. Now, they decide to do what they think is a modest Roth conversion of $50,000. They know they'll pay income tax on it. What they don't see coming is the hidden penalty. Their new Magi is $145,000 plus the $50,000 conversion. Their new income is $195,000. They've crossed the tripwire. They are now $45,000 over the $150,000 limit. Let's do the math. $45,000 times the 6% phase-out rate is $2,700. This means their $12,000 deduction is reduced by $2,700. It's now only $9,300. By making a smart retirement move, they just lost nearly $3,000 in deductions. The trap has snapped shut. This is a disaster. But what if they did a larger conversion of $110,000? Their new Magi is $145,000 plus $110,000 for a total of $255,000. This pushes them completely over the $250,000 phase-out cliff. At this income level, their $12,000 senior bonus deduction is gone. It's zero. Let's be clear about the damage. Not only do they pay income tax on the $110,000 conversion, but they also lost a $12,000 tax deduction. This means another $12,000 of their base income is now taxable that was previously protected. They tried to disarm a future tax bomb, but it circled back and hit them this year. This can be complex. The difference between saving thousands and paying thousands is knowing these numbers. That's why we've put together a free one-page senior deduction and Roth conversion checklist for you. It walks you through the income thresholds and phase-out math for 2025. It's a cheat sheet to help you with your Magi control and avoid this trap. The link is at the top of the description below. Click it and get your free copy. Section 5. Key takeaways. How to disarm the trap. Okay, you see the trap. How do you get the cheese without getting caught? You need a strategy for this 4-year golden window of opportunity. Step 1. Know your numbers. Before you do anything, you need a crystal clear picture of your baseline MAGI for the year. Add up everything before a potential Roth conversion. Compare that number to the phase-out thresholds, $150,000 for married couples and $75,000 for singles. The difference is your headroom. John and Mary only had $5,000 of headroom, but this is a significant stopping point. You have to understand this piece. Step 2. Right-size your conversions. The mistake was one large, clumsy conversion. The strategic move is to perform smaller, precision-guided conversions. Instead of $50,000, John and Mary could have converted just $5,000. This takes their income to the $150,000 line, but not over. They still get the full $12,000 senior bonus deduction and move $5,000 to their Roth, the best of both worlds. This is about surgical precision, not a shotgun blast. Step 3. Plan for the full 4-year window. This new senior bonus deduction is temporary. It's only here for tax years 2025, 2026, 2027, and 2028. You have to map out a strategy. In years your income is lower, you may have more headroom for a larger conversion. In years it's higher, you protect the deduction. You also have to watch out for other things that raise your MAGI, like selling a stock with a large capital gain. Section 6. Who can ignore this trap? Now, this trap isn't for everyone. If your income is very low, well below the $75,000 or $150,000 thresholds, you can convert with less worry about this specific problem. And if your income is already very high, consistently over the $175,000 or $250,000 limits, you weren't getting the deduction anyway. For you, the calculation is simpler. And of course, if you have no pre-tax retirement accounts, this is a non-issue. But for that massive group of retirees in the middle, this trap is sitting right in your path. This new senior bonus deduction is a rare and powerful opportunity. It's a 4-year window to save a significant amount on your taxes. But it is booby-trapped. The very tool that can secure your future, the Roth conversion, is also the trigger. But you don't have to be a victim. The power comes from knowing the rules. You must coordinate your actions, know your income, know the thresholds, and right-size your Roth conversions. Don't let a gift turn into a tax nightmare. Don't let this 4-year window close without taking action. If you got value out of this, please consider subscribing to this channel. It helps more than you know. And make sure you watch our next video on the biggest Social Security mistakes to avoid in 2025. I will see you over there.